When an aggressive, high-velocity market trend drops through a major support level, it creates a significant logistical hurdle for the institutions driving the move. This chart shows what quantitative algorithms define as the classic floor. The thick blue line is the 34 exponential moving average, or EMA. It acts as a hard boundary, separating a smooth, high-velocity trend above from sluggish, erratic market rotations below. Institutions driving these trends face a specific challenge. To fuel a continuation program, their algorithms must accumulate thousands of contracts, which requires immense available liquidity. However, strong trends rarely pause long enough to offer deep, natural pullbacks where that necessary liquidity is normally found. To solve this, institutions utilize a structural trap known as a liquidity sweep. Instead of chasing prices higher, algorithms will allow the asset to drop slightly below the 34 EMA to trigger a cascade of automated selling among smaller participants. By understanding the mechanics of this drop, you can identify the structural signal that confirms institutions have reloaded their positions. The mechanics of this setup activate the moment a market pullback approaches that 34 EMA boundary. Watch the descent toward the 34 EMA. Retail traders place protective stop losses beneath this line, forming a dense red cluster. Crossing the line triggers these stops, flooding the tape with sell market orders. But institutional algorithms anticipated this, parking massive buy limit blocks at these exact coordinates. The exact second the price pierces the 34 EMA, the trap begins to fill. Retail chartists watching the live feed see a solid red bar breaking through support. Assuming the trend has died, they manually panic sell, adding even more volume to the automated stop-loss cascade. This downward spike is a highly engineered mechanism. It forces smaller traders to sell at a discount, transferring that capital directly into the resting wholesale limits of institutional buyers. This high-speed collision of retail selling and institutional buying is called micro-absorption. This Level 2 order book displays raw physics at impact. Incoming retail sell orders slam into the passive institutional buy limit wall, completely swallowed without moving price lower. Because of their massive size, institutional blocks absorb the selling entirely, leaving the order book vacant of sellers. With no supply left overhead, the market-making algorithms instantly and aggressively reprice the asset back up above the 34 EMA. This split-second absorption leaves a distinct mark on a standard price chart. The candle body closes safely above the line, leaving behind a sharp, extended lower wick. That liquidation wick is the physical shadow of an exhausted retail panic, completely caught and reversed by institutional algorithms. A fatal operational flaw is executing trades based on how a fluid, moving candle looks in real time. While price is actively auctioning below the 34 EMA, the candle looks like a heavy, permanent red block. This illusion triggers emotional reactions rather than structural analysis. To maintain operational discipline, you must suspend all trading decisions until the current time interval, or auction loop, is completely finished. If the timer hits 0 and the candle closes cleanly below the 34 EMA, you have a failed floor. In this scenario, institutional buy programs did not defend the level. The high-velocity trend has broken, and the market is handing off to a much deeper structural support. Conversely, if the timer hits 0 and the candle has snapped back to close above the 34 EMA, the floor was successfully defended, creating a verified reclaim. Surrendering the urge to act before the candle closes is the mathematical shield against buying into a genuine structural breakdown. A visual reclaim on the price chart requires cross-verification with underlying transaction volume to be considered a valid signal. The first order flow pattern to check for is ghost volume. This left chart displays a visual reclaim, but transaction blocks print far underneath the volume baseline. This means no institutional size was involved. The order book simply drifted back up. Reclaims built on ghost volume lack structural backing and frequently fail on the next interval. To confirm the setup, you must see a volume surge. Look at the right chart. The reclaim wick forms, and concurrently, the volume bar violently spikes above the baseline. This physical transaction data proves that massive institutional capital stepped in and absorbed the selling pressure. Layering this volume intelligence allows you to separate a heavily funded continuation program from a fragile retail anomaly. This interface consolidates the execution framework: a high-velocity trend above the 34 EMA, a completed candle with a liquidation wick, and a confirmed volume surge. Execute your long exactly when the candle closes above the line, setting a stop loss 1 tick below the wick. Because institutional algorithms have cleared the supply at that level, a true high-velocity trend should not revisit the bottom of that wick. This keeps your risk parameters tight. When executed correctly, a verified chassis floor reclaim aligns the entry with returning momentum, often leading to immediate price acceleration toward the next targets. A reliable edge is built on confirming institutional order book physics once the auction loop is finalized, bypassing the noise of real-time price fluctuations.